Vargo.
Now, back with one of the best money men in the business, Switzer.
Welcome back. In recent times, small cap stocks have started to show some real form after languishing for a couple of years when big cap and mid cap stocks were attracting investors' attention. Matthew Booker is a portfolio manager at Spheria, and he has an eye for an up-and-coming small company. Thanks for coming on the program, mate.
Thanks for having me.
Tell us about Spheria.
Yeah, we set Spheria up about 18 months ago. We originally came out of Schroders, so we're the Schroders small and microcap specialist team. We started up Spheria because, you know, we're very keen on small caps and microcaps. We have a great track record in that space. We had great ratings, and we like sourcing ideas. We like finding ideas, small companies that can grow into big companies. And obviously along the way you can make a lot of money out of that. Also, we can find a lot of companies where, you know, there's valuation disconnect in that small cap space, and that offers significant upside in terms of returns for clients.
Okay, well, Matt, when you started up, I'm sure you remember better than me, small caps were kind of struggling, wasn't it? Everyone was chasing big cap stocks, chasing dividends, and the mid caps looked really good. So when you guys started, it wasn't an easy time, but over the last, say, 6 months, small caps have really come into their own.
Yeah, we've performed very well over the last 6 to 12 months. The market has definitely skewed more towards large cap. A lot of portfolios are very concentrated in the banks, a couple of resource companies and a few blue chip stocks. And what we do is we find opportunities outside of that in the small and micro cap space, and we find those companies that really, I think, complement those portfolios that are very concentrated in that large cap space. And it has been a different 12 months in the market. You know, the market has gone from momentum to value, and we found opportunity through that cycle, and we performed pretty well during that period. We think the outlook is still strong for small caps. We're finding good opportunities where companies that have been oversold represent decent value. But there's also some frothiness in the market, so some speculation, and you've seen companies basically skyrocket, and we think some of those companies are a bit dangerous. People could be buying them at the wrong time. Yeah.
Matt, can you give us a classic example?
In terms of frothiness and speculative behaviour?
Look, arguably you're saying it's probably a pretty good company, but the market's just got too long and overvalued it. Can you give us a name that you think that fits the bill for that?
Yeah, A2 Milk is a great company. Yeah, the management have executed very well over the past couple of years, and they've moved into that infant formula space, and they sold really well into China. But we think that the stock's overvalued. We think the market's taken it too far. The market cap of the company is now $5.5 billion, and that's actually nearly equivalent to Coca-Cola Amatil. And this is a company that only has $600 to $700 million of revenue. Blackmores, which is a company we own, has similar revenue, actually more, and it's trading at half the valuation of A2 Milk. So we look at some of the relativities, and we can't reconcile that valuation for A2 Milk.
Yeah, were you like me when you saw Blackmores around $90? You thought to yourself, this must be reasonable value, and are you happy that it's a lot higher now?
Yeah, we bought a lot of stock at $89 and $95 after the result and before the result. So we saw an opportunity there. The market got carried away with the negative momentum. They missed the fact that this company has been around for 40 years. It has channels into all the Asian markets. It's got a great brand. Its product is the best product in the market. And we think over time it'll continue to take share. If you roll forward 5 to 10 years from now, Blackmores will be a bigger company. It's got a very diverse portfolio, and it's very well managed, and it invests for the long term. We actually think the cost, they invested ahead of their growth, and so there has been that has hit their earnings, but we expect that to unwind going forward, and we suspect that the stock will carry on over the long term. Now, it has rallied pretty hard, so it is a little bit overvalued in our view, but if you take a long-term view, we think there's significant returns still to be made in Blackmores.
Okay, I can always remember Bill Leister from Contango liking a company that very few people have ever heard of called Catapult. And of course Catapult did very well for a while there. And then of course it's the sports monitoring product, and did very well. Do you have a company like that, one that you think really looks good and has great potential, and you've backed it with your own dollars?
Yes, Peter. We own a company called Class. It's an SMSF software company. You're probably aware of it. It has had a good run since it listed. It looks expensive on current multiples, but we think there's a good runway for this business. It's taken 25% share of that SMSF market. It's got 140,000 accounts that it's administering, and it's got the best product in the market. We actually think it can go from 25 possibly to 50% of the market. And with that, you're going to see significant upside in profits over time. We think the market's underestimating the growth in the company. We think it is a winner takes all in that market. And, you know, they've got to a point where they can invest in the product. It's got a competitive advantage, and they've built out the moat for that business. So we still see significant upside for Class.
Okay, there's a really interesting company for you to pick on, because a lot of my viewers are self-managed super fund trustees. Tell us exactly what Class does. What does it deliver to self-managed super fund trustees?
Yeah, look, at the moment, regulatory requirements in that space are heightening. It's getting, you need to be efficient in terms of the back end, in terms of software and calculating portfolio, calculating the tax position, calculating the asset position. Class does all that for the accountants. So all that manual work that the accountants used to do, and they used to use Excel spreadsheets, they still do some of them. They used to use desktop products. Class does all that in the cloud. It means that the work that the accountant puts in is much less. It's all automated. It's got data feeds from over 100 different sources. And so it really takes the pressure off the accountant. It makes their lives easier and improves their productivity. And you can see the fact that it is the best product in the market because it's taking the share. And we think that accountants will continue to adopt it. It can also move into adjacencies. So it's looking at, it's built a front end on the product, and it's moving into that family trust space. And that could actually be a bigger market for Class than the SMSF space.
And do they have a product that goes directly to a trustee? You know, that person who wants to do it himself or herself, or is it always through the accountant gate?
No, it has to go through the accountant gate. It doesn't go direct to an individual. No, it's a consolidated system. And it's basically used by the accountant, not by the actual individual.
Okay, and a hell of a lot of trustees do operate with accountants. One final stock before you go, mate. This is your debut on Switzer, so and you're doing pretty well. So
Thank you.
What's your final offering to my viewers?
Yeah, look, we focus on cash flow. We believe cash flow is critical for companies, particularly smaller companies. If they're not generating positive cash flow, and that's after all capital expenditure, you're going to have a problem at some point. If the market does shut down, these companies can't fund through that window. So what we look for is companies that can self-fund and generate free cash flow. A company we really like is Certex. We think it's a genuine growth company. All the blue sky is now evaporated out of that stock price, and we actually think it's a genuine growth company on a value multiple.
Well, you know it's been a heartbreaker at times, and so but of course you're arguing you've done the homework and you believe that the upside lies ahead.
Yeah, look, we've done a lot of work on the business and the product, and we think it has efficacy. At the end of the day, you get better quality of life on the product. So it is in that liver cancer treatment market. It gives you the same extension of life as the chemo agents, but that quality of life is much better. And we think over time that penetration rate, which is single-digit percentage globally, we think that will lift over time. Some of the costs that they've been spending in terms of R&D will drop out of the business, and cash flow will drive higher over the longer term. So that's a good growth story. It's very hard to find growth stories in this market, and when you find it, and you find it at a value multiple, you've really got to pin your ears back.
Yeah, well done, Matt. Thanks for joining us on the program. We'll talk to you in a few weeks or so.
Thanks, Peter. Cheers.
That's Matt Booker from Spheria. And in Adelaide, isn't it nice to talk to people in a different state like Adelaide? Coming up after break, the wonderful Julia Lee. Julia's not only a pleasant face on the media, she's a good picker of stocks, and she's coming up after the break.
Helping your money work harder for you. This is Switzer.